Hi guys, welcome back to the YouTube channel. In this video, I'm going to be talking to you about property and incorporating your property business. Most notably, you've seen so many of these schemes blow up and you're probably wondering, is it safe to incorporate your property business? Well, don't worry, because in this video, I'm going to spill all. Seen with Property 118, less tax for landlords. These guys have been promoting tax avoidance schemes for many years now, and basically offering a service and a scheme where they incorporate your property business with kind of jumping through a few hoops, but basically all of the upsides with none of the downsides. Effectively, that's the best way of saying this, because for genuine property tax planning, when you incorporate your property portfolio, which is what we encourage as tax advisors, chartered tax advisors, is genuine tax planning. That's not for the avoidance of tax. There's other commercial reasons behind it. And this is where you actually legally incorporate your property business. You transfer over the legal and beneficial ownership and interest. You don't split any of that out. There's no kind of contrived steps, which you might find, because obviously those contrived steps that don't make sense other than for the avoidance of tax, they're kind of indicative of a tax avoidance scheme. It's something that HMRC can challenge under various different frameworks, GAR and whatnot. And basically, this is the kind of schemes that other promoters have been put forward, most notably Property 118, less tax for landlords, where you can incorporate your property business, separating out the legal, the beneficial, whatever, how they're structuring it, so that you can get effectively your properties into a limited company without the need to refinance and various other factors. And the end result here is that HMRC are now looking into this. If you look at their spotlight, they're kind of calling out this and basically advising people to go against it. Dan, tax policy as well, he's written extensively about this and basically why it doesn't work. He's drafted in kind of very kind of senior tax advisors, solicitors who have sense checked this, fact checked this, researched it, and they've basically all said this does not work. But what does work effectively? Because you're seeing so much about how what doesn't work and okay, you don't know what to do, you're quite confused. Who do you listen to? Property 118, tax advisors, me. I guess on that, the main person you should be listening to, it should be somebody who's qualified. So Dan tax policy, why should you listen to him potentially? Well, he's a very senior tax solicitor. I used to work at Magic Circle law firm. That gives him qualification experience to be commenting on tax. Me, I'm a chartered tax advisor. That's why I'm qualified to talk about tax. Property 118, what are their qualifications? Well, Mark Alexander, no qualifications. Mark Smith, he's a general barrister who does loads of different work. So he's not a specialist, doesn't really know too much about tax and isn't qualified to talk about tax. He's a barrister, not a tax advisor. So that's kind of nips that point in the bud as to who you should listen to. They've got to have some kind of professional qualification and experience. If you're taking advice of somebody who doesn't have that, to be honest, you probably deserve to get you basically deserve the outcome that you're encouraging for yourself. Yeah, you might listen to somebody who says, oh, I promise you I can do this, but they're not qualified to give that point of view. So if something bad happens, and it eventually will, that's on you for listening to them. So what does work in terms of tax planning now? Well, still the normal property incorporations, that is sort of tax planning. As long as you're not doing the kind of one of these substantial incorporations, as long as you do it in a genuine commercial way, so you have your genuine partnership, you're not going backdating, fabricating the fact that there is a partnership. You're not kind of making backdating agreements or anything like that. You are running a genuine partnership where you've got partnership bank accounts. If you're not doing this, you could set that up. That's fine. But you're not doing any kind of fraudulent aspects or saying to HMRC that you're trading as something that you're not. That's okay. So as long as you've got that genuine partnership and you move all of your properties over to a limited company, transfer legal title, beneficial interest, the whole lot, you refinance, or you transfer your mortgages over with the lender's consent, this is still genuine tax planning. And as a result, you can still save a lot of tax in this and have the other benefits as well, such as limited liability protection, the ability to bring different shareholders and directors in, to pass the business on to future generations by using kind of a freezer share structure. These are all genuine tax planning options that are available, but they are legitimate. They're encouraged by tax advisors rather than being kind of purveyed to HMRC and kind of make the circumstances fit the facts rather than the facts fit the circumstances at the end of the day. So if you do have a partnership business and you've been trading as a partnership, typically 3 years, but there's no set guideline on this. You need to be able to prove to HMRC that you are a partnership. Then you can incorporate your property business as long as you are spending at least 20 hours a week running that business as per the Ramsey principle. And if that's the case, you can qualify for incorporation relief and then stamp duty relief as well, and then actually get all of your properties into a limited company. Of course, you're going to have to refinance the properties if you've got mortgages on them, but ultimately, you can't have everything at the end of the day. You will save some tax potentially. You'll have the other benefits of a limited company, but you've got to pay the price in terms of having to pay some ERCs or some extra interest on the refinance. So there we have it, guys. That's what property incorporations, that's the property incorporation update for where we are now in light of everything going on with Property 118. It's still an option for many, but it's not quite the big opportunity that it was, because ultimately, if you are doing something like this, you have to pay the price in terms of the ERCs and finance costs. If you find this video useful, please do give it a big thumbs up and also smash that subscribe button. Bye for now.